Hello, my name is Zoe Anderson, and I am the Business and Marketing Director at Law Business World. I'm just going to spend the next half hour or so talking a little bit about some financial considerations that you should take into account when you're planning the success of your firm, as well as some personal finance considerations that you can think of to really make your money work for you, and also in many cases to make your debt work for you. So one of the things that a lot of businesses really fail in the beginning is to plan for any kind of financial situations that might occur while you're in those initial stages. It's important to plan for a rainy day, to always plan for the worst case scenario, and to always make sure that you have just a little bit of extra rainy day funds to cover the expenses for your business, as there's always unseen costs that arise. So the next few slides are just very basic, and we're going to talk about just a few of the components that go into building a revenue model, and some financial documents that you're going to want to always have on file and to constantly keep updated for your own purposes as well as for your accountant. And then we'll talk about the revenue model just in very basic terms. After that, we'll talk about some personal financial considerations that could really help you. So there are several different financial documents that we talk about. The first of which is just a basic financial document that should help you kind of gauge what it's going to cost to get your firm off the ground, and also what it's going to cost to continue your firm in basic business on a day-to-day basis. Okay, so the income and expense report is a very simple document. You can do this using Excel, or if you have QuickBooks or any of the other financial management services to help you run your firm. It's very basic. You want to really get down every expense that you think your business is going to have on a monthly basis. So what are you going to spend your money on? You're going to have to deal with rent, whether you're having your offices at home or whether you have an exterior office. Always include the rent, of course, internet, any other technological bills that you might have to pay, electric, gas, all of that stuff. You really want to get in there. Office supplies, this is a big one. You want to make sure to get everything in there, from pens to staples to paper to printer ink. All that stuff that you use on a daily basis. Now, you can factor these costs into the actual fees that you charge your clients for particular services, but just make sure that you have those down there as expenditures that you want to keep track of. Of course, I think it's most of us went to law school because we're not good at math, so it can really benefit you to have an accountant. They're really not very expensive. You can work out deals with them, especially in the beginning. But have an accountant. They're really going to help you out a lot. Licenses, of course. In order to be a lawyer, you're going to have maintain your licenses, do your CLEs. You're also going to have to maintain business licenses. All that is very important. Make sure that you keep those down, and if you can divide those up as a monthly cost, so you can just make sure that what you're bringing in every month is more than what you're putting out. Insurance, malpractice, liability insurance, this is very important. If you go to our website, lawbusinessworld.com, in our news section you'll find a ton of articles that you can use, and one of the articles was written by one of our friends, Jeremy Evans, talks about where you can get malpractice liability insurance. This is very important, and ethically you must have it. Marketing costs. Now, in the beginning, you might not want to spend too much money on marketing because you just simply don't have that much money. to spend, but you really don't have to spend that much money actually on marketing in order to have a good return on your income or your investment, rather. Marketing costs can be anything from lunch dates with clients, networking events, attending an art show, for example, or let's say you were into action sports law. You might be able to write off some of the cost of attending an event under marketing, as well as say you decide to do a Facebook marketing page, which we'll talk about in a later segment. You can set limits on how much money you spend per month. Say you want to spend $100 a month. You do want to make sure to factor that cost in there and keep track of it and make sure that you're staying within budget. Taxes. Now, as your business goes on, you'll have a greater sense of what percentage rate you'll be paying in taxes, but it's important to make sure to put aside money each month, a specific percentage. Maybe you want to just do 15% or 20%. Set that money aside each month so that you don't get caught without any money to pay taxes at a later date. Loans. Business loans, anything that you have to pay on a monthly basis, you want to keep track of. Any kind of business savings, it's important, if you can, to put money in the bank to pay for whatever you need to that comes up. And again, of course, you have to pay yourself and anyone else, so make sure to set that aside as well. Now, by no means is this list exhaustive. But you do, just want to get as much as you can on there and add things and just keep track of it. I would say that you want to really keep track of this on a monthly basis, and this information will be very helpful for you when you do your financial report. The financial report is where you keep track of the quarterly results of your firm. So this is where you're going to take that information from your monthly report, and you're going to put it on your financial report to kind of keep track of what money you're bringing in and really what is going out. It's really a nice sort of snapshot of the health of your firm, and it just gives you a real comprehensive view as to how you're doing as a business. Now, you can find different samples of financial reports and monthly reports on the internet. We'll have something posted on our website that you can see as well, to just give you kind of an example of what it looks like. But this is some of the things that you'll find on the financial report. Going back to your business associations and corporations law class, I'm sure you remember some of these terms. Your assets, of course, are things that the law firm owns and that it contribute to the value of your firm as a whole. So you're going to have your current assets. Of course, this is cash. Always want to have cash. Accounts receivable is any sort of fees that you have coming in, whether you have retainer agreements, monthly retainer agreements, or any sort of set fees you want. You're going to have that in your accounts receivable. You might not be paid yet, but nevertheless, that money is in the bank account or in a trust account waiting to be transferred into your account when the job is done. Doubtful accounts. Well, this nobody wants to admit it, but every now and then you may not get paid for your legal services. You have a client who you've been after for several months to pay. They've not paid. That money is going to stay in the doubtful accounts portion of your financial report. And you're not necessarily going to count it in your overall assets until you actually get paid. Deferred taxes, now depending on whether you will file quarterly or just once a year for taxes, again, you want to keep that money in the bank so that you don't get caught in a way up a stream without a paddle when you do actually have to pay those taxes. Temporary investments, you might not have them, you might not need them. If you do have them, just list them. And then, of course, any prepaid expenses. Say you decide to pay your rent for the year in exchange for some sort of discount. That's an asset that you have. You know that you've got that space for the full year, or maybe even for 5 years. Those are things that you want to list. Fixed assets. You know, these can be things that you have in your like employee savings account. Say you decide to do, you know, an IRA, for example. You might also have ownership of the building in which your law practice resides. That would be a fixed asset. Of course, you're going to have accumulated depreciation. This is for things like your property and equipment, or you know, maybe it could account for inflation rates if you do have savings accounts, things like that. It's good to, you know, have this set up, but bring it to your accountant, bring it to your CPA. They're going to tell you what we're missing here, and they're going to make sure that you have everything you need to get a real good snapshot of what you know, the value of your firm is in terms of what assets you have. You're also going to have your current liabilities. This is, of course, any bills that you have to pay, and that, of course, this is where that monthly report comes in handy, because it makes sure that you know what your outgoing payments are every month, and you can calculate those on a quarterly basis. Just, you know, gives you an idea of how much it costs for you to do business. And then, of course, you've got your long-term liabilities. Say you have a mortgage, you know, anything else that might accrue that you want to keep track of to really understand exactly how much your firm is worth. This is important as someone, especially in the beginning stages. I know a friend of mine who, in the beginning, couldn't get a job, even though he was a top student. So what he did was he started his own firm, and he actually did very well in that first year, ended up bringing in about 6 figures. Of course, the firms that he had applied to saw this, and they didn't want this competition. Of course, he was taking business away from them. So what do? They bought his firm, hired him, and that's how he did it. So it's good to have all of this down on paper and to really get an accurate snapshot of the value of your firm should someone come along and decide they want to buy you out because you're too competitive with them. Now, having said all of this, you have put a lot of work into your business plan. You've done a lot of research. You know what your mission statement is. You know who your demographic is. You have put together a whole budget for how much it's going to cost to run your firm. And you've also set some goals for what you think the future of your firm can hold. You know, what you would like to see your business go. So the executive summary is really, it doesn't have to be a long document. It can be 1 page, it can be 5 pages, or it can be longer than that. It can include everything that you came up with while researching and putting together the plan for your firm. What the executive summary does is it combines the most relevant and important elements of your firm, and it gets it all into one place that you can use when either you might be seeking new partners to come in and invest in the firm. You're going to want to give them something that they can use to really see what the value of their investing in your firm might be. It also allows you to just to keep focus, keep track of what your goals are, and to make sure that you're staying on top of those goals. You're 1 year out from your business. You really want it to be expanding your business into, or your firm into other areas of practice, or maybe you want to be doing more of one thing. your executive summary will let you know whether or not you're actually staying on track. That being said, you want to make sure to stay flexible with your goals. Don't assume that just because you're not necessarily on track with your short-term and near-term goals that you're failing in some way. Some of the best businesses out there started out as one thing and then morphed into something entirely different. And so, the reason for their success was their adaptability in the market to really change with with what was needed at the time. Say, for example, you start a firm that's really based on mostly contracts and corporate transactions. But what you're finding with your clients is that they actually really need visas and immigration services. And you're finding that you're bringing in $10,000 a month doing immigration services rather than contracts. Contracts are your thing, you really like them, but you're only making $3,000 a month as opposed to $10,000 with your visas. You might want to go back to your executive summary and make some changes. Nothing wrong with that. The point is, you want to include these very important parts of your business that really help you kind of figure out what the roadmap is and what risks you might have in the future coming up. Where's the competition? What are they doing? How are you staying on top of it and staying competitive in the field? So with that being said, we're going to move into some strategies you can use to keep track of your personal finance. Now, this segment can be important for a lot of different reasons. It might not be relevant to you, but for a lot of you, especially in that first year, it may be. And this is even relevant to you if you don't start your own firm. Maybe you are working at a law firm right now, and you have the goal to start your own law firm. And you're making $50,000 or $60,000 a year, first year out of law school, second year out of law school, and you've got $100,000 in student loan debt. And you feel like you're drowning. You're not able to make your rent, or just you're having some major issues. Well, what we want to do here is show you how you can use your debt to your benefit and where to make key deductions that will reduce your adjusted gross income on your tax statement to bump you down into a lower tax bracket while putting money into a savings account that you can pull out when you're 70 years old or before then. So let's just talk a little bit about student loan debt. This has been a topic which has gained a lot of controversy. Everybody knows, we all know, that law school is expensive. Unless you happen to be independently wealthy or come from a family who is fortunate enough to be able to help you along in your legal career, chances are you're looking at about $100,000 in student loan debt, if not more. In recent years, there's been some major reforms, especially for federal loans, to help students and graduates, actually make payments so that you don't get caught in a situation where you're making, maybe $60,000 a year, but you've got $20,000 a year in payments for your student loan debts, just in interest alone. It happens. So what we've got now is a specific program called the Income-Based Repayment Program. Now, there are a lot of different options you can use to repay your debt. If you're making $100,000 or $150,000 your first and second year out of law school, you're probably not going to worry about this at all. In fact, your best bet is just to pay it off as quick as possible and get it over with so you can move on to better things. If not, you might want to consider going on the income-based repayment program. If you haven't done this yet, you're going to want to go online and just type in a Google search, income-based repayment program, and you can find calculators. Those calculators will give you a sense of how much money you will be paying back in your student loan debt based on how much you owe and how much money you've made. So this is why it's important to always maintain your tax records. You might even want to consider paying back some of those loans immediately in law school. Because if it's based on your income and you're making $5,000 a year, you're going to be paying very little. But at least you'll have started paying it back. Now, there's a couple different things that you want to consider when you're doing the income-based repayment program. First of all, it's based on your income. So if you're married and you're filing jointly, then your income is going to be based on what you're making as a couple. So if you're on the income-based repayment program, you might want to consider filing separately. This will reduce your income overall, and it will allow you to reduce your monthly payments on the income-based repayment program. In addition, and this is really important for people starting out their businesses, in the IBR, which is what we'll call it from now on, for the first 3 years of being in the program, your federal subsidized Stafford loans, interest rates are paid by the government. So if you're paying about $15,000 a year in interest, but $10,000 of that is being paid by the government, then those first few years that you're in business as a small law office, you at least won't just be accruing a lot of interest on your debt. So those are some things to really think of. Now, the great thing about the income-based repayment program, or any debt program, is that you are able to deduct up to $2,500, that's $2,500, in interest payments from your adjusted gross income. So let's say you make $50,000 a year, and you're paying $4,000 a year back for your student loan debt under the income-based repayment program. Well, $2,500 of that $4,000 is totally tax deductible. Now your income, adjusted gross income, let's just call it AGI from now on, gets reduced from $50,000 to $47,500. So under the income-based repayment program, that would mean, let's say your interest rates were 6.8%, you have student loan debt of $100,000, you'd be paying about $415 a month. Reducing it to $47,500 will reduce your interest, student loan debt payments to $384 a month. Again, you're going to want to go to the income-based repayment calculator online and just take a look at this and figure out, what you think you might be paying. So there's that. The IBR can help you manage your debt so that you can really survive those first few years. And keep in mind, that student loan debt is forgiven after 25 years. So if you never make more than $60,000 for your career, at least at the end of 25 years, you will have no more of these payments. So let's go into some other ways that you can reduce your adjusted gross income and make some adjustments. A lot of people think that putting money into a savings account, especially when you're in those first few years of business, you're not making much money, a lot seems to be going out, you can't afford to put money into a savings account. Well, you can, and here's why. In fact, I'm going to go on to say that I don't think that you can afford not to put this money into your bank account. The individual retirement accounts, there are two different kinds. There's a traditional IRA and there's a Roth IRA. And there are advantages and disadvantages to both, depending on how much money you bring in every year and what your future financial goals are. You're going to want to choose one or the other. Under a traditional IRA, you can contribute up to $5,000 into your savings account, depending, of course, on other factors. But if you're making $60,000 a year, filing separately on your tax account, about $5,000 is how much you can expect to be able to put into that account. Now, the benefits of a traditional IRA are that it's tax deferred. So you put that money into your bank account, you don't pay taxes on it. In other words, if you're making $50,000 and you just deducted $2,500 from your interest, you can deduct another $5,000 from your adjusted gross income so that your taxable income has now just been reduced to $42,500 using both of those deductions. In other words, you're going to be paying less money in taxes because you're not reporting as much money as taxable income because you're putting it into a tax-deferred savings account. Now, the disadvantages of a traditional IRA are that you get taxed on the back end. So if you want to take that money out in 5 years, you're going to have to pay tax on it, maybe a little bit of a penalty. I think it's about 15%. Or you leave it in there, as you should, until you're 70 years old, and you have to take, you start to take it out in increments. You're going to pay taxes on that amount as well. So that's the disadvantage. But if you're within a certain tax bracket, and I'm going to show you why and how, the traditional IRA is going to be more advantageous for you because it has the potential of dropping you from, let's say, a 25% tax bracket into a 15% tax bracket. Now, just to put that in perspective, at current 2012 tax levels, I believe the 15% tax bracket is under $36,000 a year. Anything over $36,500 or something around that. Now, don't quote me, but it's around that right now. You jump from 15% to 25% tax bracket. To show you the advantages of a traditional IRA using just those numbers alone, if you're making $40,000 a year and you make no other deductions, you're going to be taxed 25% of that money. So that's $10,000 taxes. If you put $5,000 into your traditional IRA, it's going to drop your taxable income from $40,000 to $35,000, and now you're at the 15% tax bracket, and you're only paying about $5,500 in taxes. In other words, instead of paying the IRS $5,000, you're taking that money, you're putting it in a savings account, which accrues interest over time. You can invest that money while it's in your savings account, and when you're 70 years old, you'll still have that money. In other words, at the end of the year, you have two options. You can send $10,000 to Uncle Sam, or you can send $5,000 to Uncle Sam, and you can put the other $5,000 in a savings account, and you keep that money forever. That's the benefit of a traditional IRA. If you're making $100,000 a year, it's really not going to matter. But at a certain tax bracket, it can really help you a lot, especially if it can just get you underneath that 15% tax bracket. Now, let's say you're making more than $40,000, you're making $50,000, or maybe you're making $60,000. You're going to want to start looking at other deductions. If you have a home office and you're paying the mortgage or you're paying the rent, and your home office takes up about 25% of your space, and of course you must be using it exclusively for the purpose of your home office, you can deduct 25% of your rent from your taxes. So that's another deduction that you can look at. Also, you want to make sure that you deduct all your business meals and travel. 50%, I believe, is what you can actually deduct of those things. So keep track of all of that stuff. You can, of course, deduct all of your office supplies and quite a bit of other things as well. It's important to keep track of these receipts, everything you can, and talk to your accountant throughout the year, once a month, if not more, and just make sure that you are really keeping track of everything that you can in order to make those deductions. So we're running out of time. But the importance of really keeping track of your finances and creating a strategy to reduce your tax liability every year is very, very important. Just to give you an example of how beneficial this can be in the long term. Let's say we're using all of these numbers. Let's say you make, what is it? I've got my math here. You make $50,000 a year, every year for the rest of your life. And even though you have $100,000 in student loan debt, if you continue to make the proper deductions and continue to contribute that money into your tax-deferred traditional IRA account, and through smart investing along the way, you manage to make an 8% return. Say it's in a mutual fund or some other fund. You have a smart tax financial planner who's getting you an 8% interest rate accrual every year. Over, let's say you start 30 years old. By the time you're 70 years old, having put $5,000 in your bank account every year that you would have otherwise been giving to Uncle Sam, you will have $1.4 million in your individual retirement savings account. That's $1.4 million that you would not have had if you failed to make those savings and instead decided that you'd rather give that money to Uncle Sam. And this, keep in mind, is making only $50,000 a year. So it's important that you really plan for these kinds of things and put that money away every month. If you put your taxes away like you should every month, whatever it is, let's say you were in that $40,000 tax bracket and you put $800 a month away in savings to make sure that you were able to pay that, by the end of the year, the actual contribution to your savings account will only leave you less than $80 a month, with $80 a month less than what you would have had if you chose not to put that money into a savings account. And that's really it. That's all we have for today in terms of personal finance. I hope that you found that my presentation to be helpful, and I certainly hope that you do speak with your accountant and take a look at the individual base repayment program calculators. Take a look at the IRS website rules. Do your own research and do the math, because you might be surprised what you find. Thanks so much.